Okay, so part two of mutual funds. So we're talking about this, this fund, this Vice fund fact sheet, and we're talking about the 10, investments in this fund. And we said that Altria had 6.44% of the portfolio. Reynolds American had 5.93%, and so on. And then, it gives you the net total assets of the fund. There's about $220 million invested in the fund, number of equity holdings, and so on, and some other data. Gary Sullivan, MBA, is the portfolio manager for this fund. So basically, if you look at the example that we're talking about, that medical doctor, the medical doctor is basically giving his money to Gary Sullivan, or the fund, and Gary Sullivan is making the decisions along with his team to invest in different stocks, and then also what portfolio weights and so on. So basically, they're delegating, their investment decisions to the portfolio manager and his team. And you can look at some of this other stuff, guys, for this mutual fund. So here's the prospectus, the summary prospectus, and then the prospectus. The prospectus is a very important document, guys, because it pretty much, tells investors what the fund is going to do with the money. So this is a very, very important document. They need to have one of these before they can actually go and invest people's money. This is the prospectus for 2016. SEC. Here's the table of contents. There's a summary section of what the U.S. Mutual Funds Vice Fund is. It gives you the principal investment strategies, the related risks, disclosure of portfolio holdings, and so on, management of the fund, shareholder information, distribution of fund shares, distributions and taxes, and then the financial highlights. The prospectus is a very important document. Once you start, investing in stuff and putting money away, you'll find that companies or investment companies will be sending you this information very often to your home. So here's here are the management fees. Okay, depending on the institutional class or the investor class. Total annual operating expenses for this fund are 1.23%. So regardless of whether you make money or lose money that year on your investments, you're going to be charged 1.23% for putting your money in here. So if you put $10,000 in there, you're going to be charged 1.23% of the $10,000, meaning that you're going to be charged roughly what? $123, right? $123 a year to put your money in there. Now, one of the major questions that I think have been posed by finance researchers is this 1.23 operating expenses justifiable, right? Is it worth it to give money to these mutual funds, and pay these fees? Do they make a sufficient return to cover these fees? And the answer is not very straightforward, but they have found some evidence that some of these mutual fund managers don't do quite well. 1 year they'll do very good, but then the next year they won't, right? So it seems like maybe some of these fees are not being justified. They're not, doing or managing as well as they say they're going to manage. Okay, so that's just one aspect of it. Tells you what are the principal risks of the fund, the performance of the fund. So look at the performance. Now, when you look at these things, guys, one thing that's very important is not just to look at the returns, but you also need to look at the risk. Okay, and a lot of times they post the return on there, but you also need to look at the risk. So the main question is, what's the risk-adjusted return of the fund? How well did it do relative to the risk it took? So you need to look at these things, guys. some more information. I'll let you look at this. We're not going to go through everything. There's 30 pages here, so we don't have time to go over everything. Okay, so let's continue on to the next part. Sometimes you'll see this style box that's on page 119. The style box or matrix will talk about value, blend, and growth, or large, medium, and small. And it's like a Morningstar style box. Let me show you real quick. Here's Morningstar. Here's Morningstar. So Morningstar has a lot of information on, stocks, bonds, and mutual funds. So where's this box? Where is it? Right here. Sorry about that. Where is it? So this is what I'm talking about, right? So you'll see this Morningstar style box, and you'll see this in a lot of the prospectus or a lot of the investments that you see out there. And basically what they do is they have this style box, and the style box on one axis has the large, medium, and small cap categories, meaning a large company or a large oriented mutual fund investing in large stocks. And what I mean large is market capitalization. Market capitalization is the price times the number of shares outstanding, right? So these would be large companies over here like Apple and so on, and then maybe some other smaller companies like Shake Shack and stuff like that. And then on the horizontal axis you have the value, blend, and growth style or characteristic. Value stocks are usually stocks that are what they consider cheap. They haven't done too well recently. Whereas growth stocks are stocks that are considered kind of expensive and have done very well recently. So if you look at this right here, this black one right here, a mutual fund in this area would be investing in large companies, right, that have done really well or that have high growth in earnings. What's an example like that? So maybe like Apple would be an example. Okay. Whereas a company on the other side of this box might be a small company that has done quite poorly recently. Hasn't done very well recently. It's considered cheap. It's fallen out of favor. So maybe like what's it called? GoPro might be in this area. Okay, so GoPro hasn't done that well recently. It's not a very big stock, so that might be this area. So mutual funds will fall in some of these categories. Okay, they might go all out and invest in large companies that have done really well, or they might invest over here in large companies that haven't done particularly well recently. So you want to look at this equity style box. What's also important is to differentiate between municipal bonds or municipal debt. So municipal bonds are, municipal bond funds are funds that invest in, municipal bonds, and these municipal bonds are like local or state bonds. They're not necessarily U.S. federal government bonds. I also want to talk about what they call exchange-traded funds. Exchange-traded funds are a relatively recent development. ETFs, as they're called, ETFs are very, very important, and they're kind of like replacing your traditional mutual fund. So you can think of an ETF as being like a mutual fund, but the difference between the ETF is that the ETF is actually traded in a stock exchange, and also you can buy it and sell it every day. Whereas some of these, during the day. Whereas some of these mutual funds, you can only buy them or sell them once a day. So ETFs, you can pretty much trade them like a stock, many, many times during the day. And ETFs also fall under those different categories. They have stocks, commodities, bonds, and all this other stuff. So ETFs are really cool. They're growing like crazy. People are pouring money into ETFs. The cool thing about ETFs is that they can replicate pretty much anything that you want out there. So if you want them to replicate a portfolio of large stocks, they can replicate that. If you want them to replicate industries, they can do that. So they can replicate the healthcare industry. If you want them to replicate a certain commodity like gold, they'll replicate gold and so on. So ETFs are really, really cool, and they're really helpful in investing. So one ETF that we can look at is SPY. So SPY is the SPDR S&P 500 ETF Trust. Okay, so this is pretty much an exchange-traded fund that replicates the movement of the S&P 500. So let's go look at it. So here it is. If you wanted to invest in the S&P 500, you can't invest in the index directly because the index is an index. It's not there for investing. So the only way you can invest in the S&P 500 is to buy a mutual fund or to buy an ETF that replicates the movements of the S&P 500. So here's the performance of the S&P 500 ETF. Ticker symbol SPY. And as you can tell, the performance today was minus 11 basis points. Okay, and here's the chart for the ETF year to date. Here's the interactive chart for the S&P 500. Come on. Takes a little bit, guys. Okay. So what we can do is we can compare it to the S&P 500. Okay. The performance to the S&P 500, and then we can remove some of these indicators that I don't want. Okay. So here it is. So SPY is the ETF, and then GSPC is the actual S&P 500 index. If you look at them, they track almost identical. Okay, the green line is the index, the blue line is the ETF. So if you invest in this ETF, you're pretty much getting the returns of the S&P 500. So it's that easy. You just buy one thing, you buy the S&P 500 ETF, and that's the same as investing in the whole S&P 500 index that has 500 companies, and the investment is proportional to the market values or market caps of each company. So it's very, very easy to do, very easy to invest, and that's why people love these ETFs. Now there's other ETFs out there. There's a Europe ETF. Look at this one. This is the FTSE Europe ETF. FTSE is an important financial company. So what does this one do? What does this FTSE Europe ETF do? Let me see how I can get out of this. Go to summary page. Okay. All right. So it gives us a summary here. The profile. Or it is. Fund summary. The investment seeks to track the performance of benchmark index that measures the investment return of stocks issued by companies located in major markets in Europe. Okay, so this ETF tries to replicate the performance of major markets in Europe. We're out of time.